Welcome back, everyone. Next on the agenda is the IAG's presentation on firm and engagement performance metrics to the PCAOB board. As this group knows well, the topic is on the PCAOB's short-term agenda, so the presentation is very timely. The panel will be moderated by Lynn Turner, while Bob Conway, Preeti Chowdhury, and Stephen Yang are the discussants. We have shared bios of the presenters at the end of the agenda that was circulated, and with that, I will turn it over to Lynn.
Thank you, Amy. The firm and engagement performance metrics, or as I prefer to call it, AQIs, audit quality indicators, really got a life of its own back during the work of the U.S. Treasury Advisory Committee on the Auditing Profession. And as one of the members of that committee, we were charged with taking a look at what would improve the sustainability of the auditing profession. And during that, part of our discussion centered on audit quality, because as a committee, we felt that the thing that would perhaps most help the sustainability of the firms was if they were putting out a high quality product. Along those same lines, then, in a 2018 CFA Institute member survey, the analysts in the CFA were surveyed, and they came back and said that developing actionable audit quality indicators that enable effective monitoring of auditor effectiveness is a high priority. So it's clearly an issue that is important to the firms, is important to investors, and quite frankly, is very important to the capital markets, because it's that audit, trust in the audit, that gives people the ability to trust the numbers they're using to make investment decisions. But along those lines, first, before I get going too far here, I'd like the panelists to just let everyone know a summary of their bios, especially as it relates to this issue of audit quality. And so Preeti, could you start, and then Bob, and if we get Steve to join us, we'll ask Steve to chime in too.
Great. Good morning. My name is Preeti Chowdhury. I am professor at the Dhaliwal Reedy School of Accountancy at the University of Arizona. I'm a former academic fellow at the PCAOB, and in that capacity, I have done some research and analysis using some of the PCAOB's data to evaluate some of the AQIs that we're going to talk about today.
And Preeti, did you work at a firm? Were you an IT auditor, or did you have a position at a firm?
I did have a prior position at a firm many years ago, but not for very long. I think I stayed there about 1.5 years, and then I worked as an internal auditor at the Washington Post Company. Okay.
And Bob, you of course had a long career at KPMG. Could you tell us about that?
Sure. I'm a retired KPMG audit partner. I was there for 27 years, 17 years as an audit partner. After retiring, I joined the PCAOB. I spent 9 years leading inspections. I was also the office leader for the Southern California offices of the PCAOB. More recently, I've been the last 4 years doing expert witness work involving auditing and accounting matters. And during the pandemic, one of the silver linings was it gave me some time to write a book about the profession called The Truth About Public Accounting. I also, part of the reason I'm here is I wrote a letter, a public comment to the ACAP committee back in 2007 that I think helped start in motion this whole idea about providing more transparency to how audits are conducted.
I I think it's fair to say that if we can blame this whole project on Mr. Conway, because he wrote an absolute fabulous letter to the ACAP group, and that allowed us to focus on the audit issue, and his what he had to say in the letter resonated with all the 20-some people on the committee. We've got a third panelist that we're having issues getting online, but his name is Stephen Yang. Stephen was with KPMG for a couple of years and then with EY in the tax area, as I recall. So Stephen did do audits. He focuses, if I recall right, in the healthcare area, and he has served as an analyst with a couple of investment funds, so has that audit background combined with investment decision making. So if we can get him on, he'd be he's fascinating to listen to. So, but with that, let me go back to Bob. Bob, of course, you started this off, so to speak, and so could you give the group just a little bit of historical perspective on how we've gotten to where we are and what that's looked like?
Would be glad to, Lynn. Just to hit some of the high points, to me, one of the big things that came out of the advisory committee on the auditing profession, it confirmed something that I had suspected, and that was that audit committees have very limited information to base their auditor retention decision on. And if you think about it, you've got a proposal, it's got a fee estimate in it, it's got some information about the engagement team members, and beyond that, it's a lot of promises about what the firm will do. What we're trying to do with this initiative is move away from promises to, okay, what do the firms have to say, to show in terms of their actual experience, particularly on the human capital side, but there are other aspects of it that are important. So that I thought was a big launching point for the interest in this initiative. During the proceedings, Don Nicolaisen, former SEC chief accountant, he was the co-chair of ACAP along with Arthur Levitt. He made an observation that I thought was really attention-getting. He said the firms compete primarily on the basis of cost. That's been the history of the profession, and it's been disastrous for investors and for the firm. So and to me, that's a real attention getter. In 2015, as you all know, the PCAOB issued a concept release on audit quality indicators. In 2016, the Center for Audit Quality followed with a pilot testing of AQIs using real audit committee members, and the sharing of AQI data stimulated a lot of good discussion. The output from that effort, the CAQ thought there was widespread support for audit quality indicators. The only issue that came up was the audit committee members needed more context. And I raise that because I think there's a very simple solution here. If you have engagement performance metrics at the engagement level, it's very simple to add those metrics for all the public company audits in one office, and you've got office-wide engagement performance metrics. So if you're an audit committee member and you're looking at the metrics of your incumbent auditor, you can then compare those metrics to the other competing auditors in the same geography. And so that's what gives you the context, and that's what I think will begin to drive competition on things that I think are pretty important in order to be able to conduct a good audit. Another item caught my attention. November 2022 SEIAG meeting. Dane Mott, who's a member of that group, he's an analyst at the Capital Group, he's a CFA and CPA, and I found it interesting to learn that he devotes quite a bit of his time trying to identify elements about the auditor that would be useful to factor into the investment decision. And he expressed a strong need for more information. In his enthusiasm, he said, in so many words, don't worry about how you define the audit quality indicators, just give us the data and we'll figure it out. I'm not sure that that's the solution, but what my point is, there was a real thirst for information there, and I thought that was compelling to think that it really drove home the fact that investors, do have an interest in this information. I want to finish with just level set, because I talk about the audit firm staffing model a lot. And in a nutshell, and I'll back it up with some statistics here in a minute, but in a nutshell, at the staff level, you've got heavy workloads that drives high turnover, that drives experience levels down. It also reduces year-over-year continuity on individual audits, which you'll hear in a little bit is an important factor. And then at the partner level, they've got heavy workloads. I thought it was interesting in the last discussion, Jennifer Joe mentioned in the Markham situation, heavy workloads being an issue. A heavy workload can undermine the audit partner's ability and need to conduct, get his nose in the work papers, conduct a thorough review. When I look at this model, what strikes me is I think it's really a mismatch when you think about the level of complexity that auditors are expected to master to do good audits. You've got complex accounting rules, complex auditing rules, complex methods of commerce, complex legal elements, not to mention the international dynamic. And so I just think the existing model is a mismatch for what is really needed out there. And I think the audit quality indicators might be a pathway to improve that situation. I'll finish with just a couple of quick statistics. These came out in the PCAOB's proposed quality control standard, providing some background information about the profession, and academia contributed a survey that said that audit staff report working on average 72 hours per week during the busy season. Another report from academia, identified a threshold at which, when the workload goes beyond that threshold, audit quality begins to suffer. And the data was suggesting that auditors on average are 5 hours per week beyond that threshold. That might not seem like much, but it said sometimes that number moves up to 20 hours per week past the threshold where they feel audit quality begins to deteriorate. So these are real issues, and there's a risk that auditors start to fatigue and deadlines creep up, that less than optimal judgments will be made about, should I do more work, what should I do given findings, et cetera. So that's my nickel's worth.
Let me say that when we started doing work on the panel, I went back through the auditing standards and what the profession has done on this in the past. And up until 1974, not much had been done at all. And then because of congressional investigations and hearings, the profession issued their first auditing standard on quality assurance at the end of 74, beginning of 75. And but the interesting thing about that and the subsequent updates, and there's been a few updates since then, as well as the profession developed a couple of years later their standards on quality assurance. But in all of those, and really up to this date in the US, there's never been a definition of what is a quality audit. They've not defined what a quality audit is, nor have they really laid out the factors that go into a quality audit. We sent around a letter that the Financial Reporting Council developed in the UK in that respect that is quite good and helpful. And also Sandy Peters sent around a definition from, I believe, England on audit quality that looks quite good. But here in the US, nothing has defined it. And one of the things we're going to do is come back and poll everyone on the IAG as to whether or not you believe the PCAOB, if and when it does a proposal in this area, should they define what audit quality is. And to that point, Preeti, can I ask you how you look at and consider audit quality?
Sure, thanks, Lynn. That's a great question. And it's a tough question to answer. I think about audit quality as comprising three primary components. The first is whether the auditor is performing the necessary processes and procedures to be in compliance with the auditing standards. And this more or less is what the inspection process largely focuses on, and certainly what the Part 1 findings focus on. A second component is, how or whether the auditor has used sound and appropriate judgments, because there's a lot of areas within the standard that don't specify XYZ steps. They're more principle-based. And this is a little more challenging to evaluate. It's more beauty is in the eye of the beholder there, because it's a judgment. And unfortunately, the PCAOB does not really focus on this aspect of audit quality when they write their Part 1 findings. So in my opinion, that makes the Part 1 findings somewhat of an imperfect assessment of audit quality. And then I think there's a third component that's probably very relevant to investors, and that is whether the audit standards themselves actually cover the appropriate audit procedures that investors really want and desire them to cover. And I kind of think of this third component as the expectations gap of where the audit is and where we would like the audit to be. So I think if the PCAOB is going to tackle this difficult task of defining it, it may be helpful to think about these three aspects.
Thank you, Bree. I think that's right on target. I do think there's the question of, has audit been performed in accordance with the standards? And then not only did they comply with the standards, how was the quality of the work that was done to meet the standards? Was it sufficient as well? And was the performance good? And then, as you mentioned, the expectation gap, which has been discussed a lot, but in the Cohen Commission report some time ago, they said it's not so much an expectation gap as a performance gap, that the auditors have not performed up to the level required by the standards. And then that gets into Preeti's last point, that there's probably some belief amongst investors that the standards don't ask the auditors to do what investors would like to see done. So, but that takes us then to our third question. First, let me just introduce Steve Yang. And Steve, thank you very much for joining us. Greatly appreciate that. I asked Bob and Preeti just give a brief background of themselves and their experience in this area of auditing and investing. Could take just a minute or two and just give us your background.
Yes, no problem. Hey, thank you very much, and everyone. Hi, nice meeting everyone. My name is Stephen Yang. It's not Stephen Aquila. Aquila is the firm that I work with and work for, and I was actually slotted into the observer room, and then so got moved here. Anyways, my background: I am a CPA as well as CFA. I come from a long line of accountants. My mother's side of the family are all either controllers, CFOs, And I started my career at KPMG doing audit work, and worked in corporate accounting, and then transitioned. Now I'm at a firm that I cover high yield as well as equity. So has a little bit of a hybrid role. And I've been in investment industry for about 15 years plus. I also participate with with FASB on helping them set accounting standards. So really passionate about working with the accounting regulatory bodies and meeting everyone here. So that's my background.
Thanks, Stephen. Let me move on to the question then for all three of you, if you will. Maybe you could start, Bob. I think you've already touched on some of these, but what in your views are the main ingredients or the factors that result in a quality audit?
Well, to keep it simple, it's complicated, but I really boil it down to three different buckets. The first one, very important, the focus of a lot of my work is the human capital bucket. Auditing is labor intensive. Like any job, you need time, experience, knowledge, and supervision. Then there's a middle bucket, I'll call that methodologies, policies, controls, procedures, training, just sort of the how you operate. This is an area that I think the PCAOB looks at closely as part of its inspections. And then the last bucket is very intangible. I call it the fortitude to do the right thing bucket. And I think it's important to understand what I'm painting here is a spectrum. On one end, the human capital part that can be measured, and in fact, the firms measure it regularly as part of their operations. Things like turnover, experience levels, workloads, etc. When you get to the other end of the spectrum, the fortitude to do the right thing. Here's where it gets complicated and it gets very intangible, is much more challenging to measure. It's important to understand that there are an array of pressures that are eating away at audit quality. The biggest one, which is really kind of the core independence issue, it has to do with the tension between audit quality and client retention. The reality is partner workloads are really key to partner job security. If you've got a large book of business, you've got good security. Nobody wants to be the partner that loses a big account. Nobody wants to be the partner that sees their book of business evaporate. So unfortunately, there are some issues there that weigh on audit partners' minds when it comes time, that moment of truth, to have the fortitude to do the right thing. Another is this conflict between audit quality and profitability. Not everybody gets to the same balance point. It can be a very personal kind of thing. But again, this is why we have the PCAOB, to make sure nobody's cutting corners. I always say auditors are not like engagements are not like going to McDonald's or Hertz Rent-A-Car or Hilton Hotels, where you understand what the service level is, what the expectations are. Audit engagements are very unique. They vary considerably from team to team. Part of it is the team composition, which is the human capital element. But then part of it are these intangibles. Not all partners do the same depth of work paper review. Some have their noses more in the work papers than others. I think that can be part of the root cause analysis that the PCAOB advocates. Partners are not uniform in when they seek to consult. There are required consultations, but then there's a kind of a gray area. Some partners are more consultative than others. The last one would be the degree to which the partner welcomes problems, issues, and contrary views. Some audit partners create a very open yeah, let me tell you about the problems. If you have a different view, speak up. I want to know. I want to follow the firm policies and procedures for resolving these sort of things. Other partners can apply undue influence over the staff, and that can undermine good audit quality. So that's just similar to congruent, I think, with the things that Preeti talked about. But I wanted to emphasize there's some part of it is very manageable. That's the human capital part. Part of it is very intangible. But I think there's a lot of benefit to measuring and reporting that which does lend itself to measurement.
Preeti or Steve, you got anything you'd like to add to that?
Steve, you want to go first?
Yeah, sure. Definitely as investors, any relevant and consistent information would be appreciated on the audit quality. But it's important to acknowledge that a lot of investors, while they understand general accounting principles, many are not accounting majors or have formal trainings in auditing. So they don't really have as much knowledge base. So it's important to make sure the information is provided in a sort of relevant as well as consistent factors for the user financial statements. And then that there's some sort of reliability in the financial statements. So that's things I'd like
That's
to
a great point, Steve. I think it's correct that one concern about metrics is possibly to make sure that they're reliable. And so it would be best if the PCAOB could clearly define how they should be calculated. And even better if they can review that process or the calculations as part of their inspection process to ensure that firms are consistently reporting, so that makes the metrics as comparable as possible. I think another issue that we are sort of dancing around is the relevance of the various metrics. And there's certainly a challenge out there that there's limited data about how various metrics, what they may look like and how they may tell us something or not tell us something about measures of audit quality. But I think we're going to have to be comfortable that this process is going to have to evolve over time, and investors are going to learn how to use the metrics and in what situation specific metrics will be better or more helpful in indicating audit quality versus others.
The point Steve and Preeti just made, I think, are key. That is, there is not really much data out there for investors that's provided to investors today. And when I ran the research group for Glass Lewis, and we provided research to many funds, both large and small, they did want to get the data, but it's just not something you could capture or was captured or was coming out of the firm. So in the ACAP hearings, we inquired of the firms about this and delved into it with them. And it was abundantly clear that not only was there not data out there for investors, but there wasn't a host of data internally in the firms that was being measured either. And of course, there's the old axiom, you manage what you measure, and there was not the measurement going on, not only on the outside, but on the inside. And given this is so important that the firms have high quality audits to be sustainable, it's certainly an item that should be on the agenda of the PCAOB and is going to have to be thought through without a doubt. But in light of that, there's a question as to then what is the motivation for disclosure? Preeti, what's your thoughts on that?
So Lynn, I think that right now what investors can see is basically a binary pass-fail audit opinion, right? And then because the SEC doesn't really accept qualified opinions, it's more of a pass-pass situation. And so this results in cost competition because there's limited ability to even compete on quality given it's not really visible. And so auditors can compete by making the audit less costly, by making salaried employees work more, as Bob pointed to earlier, and that's going to increase the profitability of the audit. And of course, the profits of the audit are largely shared by the partners. And then a further point that Bob brought up earlier is that because the client picks the auditor, right, then the auditor is more likely to retain the client if you curry favor to them at least some of the time, rather than playing hardball. And that's important because a big part of audit profitability is driven by auditing the same client year after year. The audit becomes a lot more profitable, when you have this continuity. And so the question is, where is the incentive to deliver the high quality, that aspect coming from? And assuming that in the market, we're not going to make any major changes like, assigning auditors to firms or, mandatory rotation, which may or may not be a good idea. I'm not saying it is, but if we're not going to make these kinds of major changes, then investors have to be able to see something that tells them about the audit process in order for the firms to have some competition on quality. And so, and that information in these metrics is not only going to be helpful to investors, but most importantly for the audit committee that directly has oversight over the auditor, over picking the auditor, and also prodding the auditor to do what they think is necessary. So I think it's going to result in better monitoring. So, if we want to change the game from a cost minimization game to a quality competition, then we have to have some more information in order for that to happen. That's my view.
Steve, let me come back to you. Is there anything that the board or people, investors need to be thinking about in terms of disclosure of these indicators of quality? You mentioned in that not all the funds, and quite frankly, maybe not even a majority of the funds, have a group that delves in and does research on the financial statements. As we've talked about, obviously Capital Group has that type of team. Certainly at the Kinnikos Fund, Jim Chanos, Muddy Waters, those all have that type, but that may not be the typical normal situation. Any thoughts from your perspective as to if these disclosures are going to be made, things that the board needs to be thinking about when making those disclosures?
Yeah.
Requiring them?
Like you said, there's different types of investors out there. There's quantitative, investors. There's companies that focus on factors. Even nowadays, ETFs, right? Basically, what's in the benchmark is what the ETF holds. So there's different investors. There's so it's for us, but one common thread is that everyone uses the financial statements, right? A lot of people use the financial statements, whether it's banks as well as the creditors, as well as equity investors. So it is important to give assurance that these financial statements are what if they're supposed to show. So an area that I typically focus on is there's enough checks and balances, some oversight, and I don't know the specific metrics that could go into this, but this right now we're seeing a lot of the financial statements are just the FTX issues. You don't know who's checking these balances. There's no oversight. You're getting arm's length transactions that are not properly accounted for. So these are some of the items, but for me, really understanding some sort of oversight or metrics around that is important that in that area.
Excellent. Thank you. Bob, do you have anything to chime in there?
Just kind of big picture here. I've been in this profession for 45 years, and I can tell you consistently from the beginning of my profession, my start in the profession to today, there's been this constant pressure on productivity and cost reduction. And I'll point to the offshoring effort as the most recent element to roll out. And within a range, I think some of it makes sense, but I see it more importantly as a red flag of how much of the firm is really being under stress. And audits unfortunately are falling victim to that. I think the commodity pricing audit as a credence good, it's hard to tell the value of what you're getting is the culprit here. And you counter that by getting information out there. People have frequently said, Bob, you just think audit partners should make less. And I say, no, that's not the case at all. I think there's another equilibrium point here where if the firms make the investment in better workloads, staff retention, better salaries, there are other things that play out that will be to the firm's benefit. Number one, if you have better continuity, you'll have all kinds of efficiencies. The way it is right now with heavy turnover, those efficiencies are out the door on a regular basis. And you look at the money that's spent on bad audit quality, legal fees, settlements, adjudicated, claims, enormous amounts of money. If you can drive that down, that will be to the benefit of the firms. And then if you do a better job at retaining, you won't have to spend nearly as much money on recruiting and training. And so I think there's a better equilibrium point. We just need to free up the competition to get to that point.
All righty. Well, let's move on to then what might be considered the key issue at hand, and that is what audit quality indicators do you think should be disclosed? When the PCAOB put out their release in 2015, they came up with a list of 28 indicators that I thought were well done, but obviously different people have different thoughts on that. In my mind, you have to look at both firm-wide indicators. For example, is compensation at the top tied to the quality of the audits that are underneath their supervision and being performed? So in a way, I think the same things that we have ongoing at public companies in terms of good governance, independent governance, transparency in financial reporting, and important metrics in the firms. I was a partner leading one of the business units inside my old firm, and we knew that investment in personnel was going to be about 40%. And that was the key metric. And it also gave you some indication as to where you were investing versus other firms investing, and who was and who wasn't investing in personnel. So those type of firm-wide metrics, to the point Stephen was just making, what type of oversight and the quality assurance function is going on inside a firm. That's key. But then there's also metrics that Bob was talking about at the engagement level in terms of continuity of personnel, experience of the people on the job. Typically, audit partners put in 5% of the total audit hours, a manager 10% to 15%, and then the rest will be the senior, who's a key player, and then the staff and what's the experience of all those people. So there's metrics at different functions or levels in the firm that can provide you some indication of what the quality of the audit is that's going on. So with that, let me come back, and as we think about that, let me ask each of the three of you, what are some of the audit quality indicators that you think would be useful in assessing the quality of an audit, and why? And let's start with at the firm-wide level. Bob?
Well, definitely agree that there's a lot of firm-wide information that's relevant. I think it's, the things that come to mind, again, I go back to the cost of poor audit quality, crisp reporting on settled claims. I mean, some of these things are already required by the various stock exchange listing standards. But the notion of linking performance to audit quality, very important. Things like audit opinions issued and clean opinion, but the issuer, fails, within 12 months of the, report date. I think there are a lot of good things to be captured. My focus has been more in the human capital element, which I hope and trust we'll get to in just a second. But I think you need a mix of both, the big picture and then the engagement level, and again, to some degree, office level.
Brady?
So I share Bob's enthusiasm for the engagement level data. I think also there could be a role for having some data at the firm-wide level. And as I turn to some research, I think there's some research, there's not a lot because there's not a lot of data that's been shared with researchers, but there's some out there that suggests some firm-wide issues could affect audit quality. So one paper that comes to mind is Daniel Abdia 2020's paper published in Management Science, where he also had access to the PCAOB data, and he studies Part 2 findings, which are a proxy for the quality control of the audit firm. And they're basically generated either from aggregating patterns across Part 1 findings or the PCAOB's specific review of the audit firm's quality control system. And basically, he finds that the worst QC in audit firms is associated firm-wide with poor audit quality via restatements, and also associated with non-audit services, which suggests perhaps they're serving as distraction in some cases from audit quality. He finds that worse QC quality control is also negatively associated with audit profitability. So that kind of gets to the point Bob was saying before, there might be a better equilibrium. It's not necessarily that we're trying to hurt the firm's profitability. These actually may improve the profitability of the firms and their ability to retain people as a respect of that. In my co-authored paper with Professor Jay Chen, I found some evidence that audit quality is associated with firm governance. There's also some limited evidence out there on the value of training. Of course, theoretically, compensation and incentives should definitely affect audit behavior. So anything at the firm level about those would certainly be appreciated. I did give Lynn kind of a short list of some research papers on some of these metrics. I don't know if he shared that with you all, but certainly if you're interested, either him or I can send that out to you. It's not meant to be an exhaustive list, but just to give you some idea of what the research has covered and what they're basically saying. But so far, what little research we can find about some of these firm-wide topics certainly does point to the value and importance of them in their association with audit quality.
Anything you'd like to add, Stephen?
Yeah, one thing I'd like to add is just, I, as an investor, we typically, I think it's the way the structure is, as investor analysts, we're typically grouped in industries. So I would cover industrials or banking. Another person would cover banking. And most audit firms are more regional based, right? You got KPMG, Akron, or and that does all the clients in that region. So for me, I think a firm-wide review would actually, some sort of metrics give me assurance, because I look across different financial statements, and it's noticeable when one financial statement is done a little bit different than another within the same sector. So some sort of metrics firm-wide review would be appreciated. Secondly, as the world gets a little more complex and there's international arm's length transactions, that's something that's important for me, because you're relying on, KPMG in Japan or Europe doing the audits, and some sort of metrics to help me better understand, or give me some sort of level of comfort in the financial statements would be helpful. So.
Interesting you bring that up. About 2 weeks ago, I had a conversation with one of the senior leaders in one of the big firms, and that person was telling me that one thing that very few, almost no investors are aware of is the amount of the audit that is actually outsourced overseas to a service center, and that most, if not literally 99.9% of investors don't realize that a very significant, maybe a third of the audit work is being done out of one of these service centers, which raises the question of, well, how much of the audit work are you sending to the service center, and then how is that service center overseen, and what's the level of expertise and supervision there, especially if it's, for example, a group in India working on an audit of a company in Canada or the US. How do you make sure that those people are trained on and are aware of what the rules are in the country that the public company is domiciled in? And on governance, it's kind of the same type of thing. What is the composition of the board? And are there anyone on that board that's overseeing anything? Do we have the same type of independent board members that oversee compensation and setting a compensation as you see with other public companies? So, and I think, well, I did send around to a bunch of the public transparency reports of a number of the firms, but when I read through those reports, I find those reports tend to be more marketing type documents rather than really substantive documents that delve into the audit quality. So you got any thoughts on that, Preeti?
I share that view. I've read a few of them, and they give you a little bit of insight into how the audit firms govern their, internally, but they're not very specific. They're very inconsistent from year to year. They're certainly very inconsistent across firms, and they might tell you something like, we reviewed X number of engagements for independence, but then we don't hear anything about, well, here's how many violations there were versus how many, were clean, and here's what we did about those violations. So they kind of give you a very limited view of what's happening. But if we turn to the firm-specific metrics, which I think Bob and I both share a lot of enthusiasm for those, specifically related to human capital in particular. I've had the opportunity to look across some of the PCAOB's data that they've gathered across a large number of inspections, and more commonly around the larger 8 audit firms. And I share this view that this human capital quality or aspect of managing human capital within the audit firm seems to be pretty important. So we found some evidence in one of our papers that's recently published in TAR that retaining the engagement team is significantly associated with audit quality via lower propensities to restate and lower propensities to have Part 1 findings. In particular, we find that the retention at the level of manager and senior manager is particularly important. So we didn't even just look across the whole engagement team, but specifically at some of the different groups or levels of experience. And we're finding that the manager and senior manager are most crucial, whereas the audit partners, retention and experience is less, which is not surprising given they are required to rotate, right? So we also find in another working paper I have with Jake Sigler that also uses PCAOB data, we find similar evidence that manager and senior managers' contribution to the IT audit is also particularly important, and their experience and retention is quite valuable and associated with audit quality, specifically when the IT environment is more complex. There's other research out there that finds, that in the list I gave Lynn, that finds evidence that heavy workloads and less supervision is associated with poor audit quality, consistent with the comments that Bob has given from his experience. And also some empirical evidence that offshoring can reduce audit quality, another point that we've talked about just now. So there's certainly a variety, or let's say there's a large amount of differences possibly across these audit firms in terms of how they're executing the audit. And it's not necessarily the case that, if you just don't have, there could be substitution effects is what I'm getting at. Maybe if I have less experience from, a manager or senior manager, I make up with that with more review or something like that. And that's totally possible. But unfortunately, we just can't see it. It's not externally visible. And so being able to see some of those trade-offs is part of the learning process of using the data.
Thank you, Preeti. The issue of then AQIs at a specific engagement level is certainly something that the CFA Institute in its survey highlighted on. Any thoughts from either of the three of you with respect to one specific audit engagement AQIs you would use? Again, the PCAOB put together a pretty good list in their list of 28 in their release. But any thoughts on those, and equally important, why you think that would be useful to put in the hands of investors? And I guess, Bob, you've talked about a number of these on a human resource level. Mm-hmm. Anything you'd add to what you've already said?
Well, I think the idea here is to get the audit firms competing on, things that have something to do with quality. And clearly the human capital element is an important part of that. What I'd also like to see is the audit firms competing for people, using these metrics. We've got this pipeline issue out there, and I think pay is part of it, but I think the environment, word gets back to the college campuses pretty quickly about auditing being a tough road to go, and so that's why enrollments are down. That's why I think part of the reason we have the pipeline problem. I think pay is an issue too, and then that kind of intersects with the the cost pressures. And so I think these metrics can move the needle, but the fastest moving component of the needle might be the competition for people. I think nobody wants to go to work for the firm that has the heaviest workloads, the poorest levels of supervision, highest turnover. People want to go where they can flourish. So that's kind of my dream. I've got my list of metrics. Maybe there's a way we can submit that under separate cover, or I can just run through them real quickly. Either way.
Why don't we get you to write us a letter?
Sure.
I know you've sent in a couple letters to the PCAOB, and maybe that'd give you a little more time to put them together, and also a discussion of why those things and are important to get disclosed.
Be happy to do that.
Stephen,
Yeah.
anything specific? You mentioned a few things already.
Yes.
Anything you'd want to add?
No, I think for me, just when I look at data, there's three key factors I typically focus on. Typically, understanding where the source and how the data is gathered. Secondly, is it consistent and is comparable? A lot of times, as analysts, we look at things year over year, so we always compare what was done the prior year. And the last thing is relevance, right? Able to make some sort of informed judgment from the data and the metrics. So that's sort of these are the three key areas.
I'd add a couple things. Independence, I think, and I think you might have mentioned this, Stephen, independence is a critical factor.
Right.
And we know that there's been many violations of the independence rules, and we're finally, thank you, Ms. Williams, starting to see that in the inspection reports. I know that's a key item near and dear to your heart, Board Member Stein. So I think it's important that the firms have to come back and tell us whether or not they've complied with the rules or not. And this notion of, well, if we haven't complied, but we can get the audit committee to approve it, then we don't have to tell anyone, that's extremely problematic. So a strong indicator is, have they complied with the rules or not? Just that simple, because at the top of their report, they say report of independent auditor, and all too often that's not true. And we need to know if they have violated the rules. The other thing is something about the assessment of client risk, which is noted in the PCAOB report or proposal. And it's important because a lot of the audits that the PCAOB inspection reports address seem to be high risk. And you would think that if they were high risk audits, they'd be putting their very best people on them. And rather than seeing the high rates of deficiencies that we're seeing, they'd be low rates because the very best people are supposedly on these high risk audits. And the firms go out and argue that the deficiency rate is abnormal because the PCAOB is picking high risk audits. And if that's the case, then why don't we have the best people on them? And if we do, then how are we still having these defects with the very best people on those? So I think the client risk thing is very important. The last thing I'll mention, and this goes back to the ACAP report, under SOX, you have to rotate the audit partner and quality control review partner and the manager every 5 years. And it's usually a huge red flag when they rotate the manager or any of those people in less than 5 years. It raises the question as to why someone's getting rotated off an audit. And all too often in the past, it's been because the management team wanted someone else assigned to the audit. So it would be great both at the audit and at the firm-wide level to have information that tells us how often on an audit, or if it occurs on an audit, but also within the firm, then how often were the partners rotated before they were able to fulfill their full 5-year commitment on that audit? So I would add that thing into it. One of the questions we had, though, was there is data here, a fair amount of data, and the question becomes, and I'll throw this one in your direction, Preeti, if you're going to put this data out there, what format, and I'll throw it out to you too, Stephen, what format do you want to receive that in? If it was me, I don't want to see another Form AP that's a PDF that's non-searchable and all. How can we best deliver this information to the capital markets and investors?
That's a great point, because just having the information only gets us part of the way, right? Ideally, we would like a website where you can aggregate the information that permits, like, massive downloads of the data. And that way people can aggregate, if they want to look at the office level, if they want to look at the firm level, if they want to look at the region level, or as Stephen mentioned before, if they want to look at the industry level, there are different ways to aggregate the data. So making it sort of detailed, but with an ability to do a large download will kind of make it the most accessible to a variety of constituents. If there is even a way to have it give you averages or sums across, like I said, industry, audit firm, or audit office, that would be even better. But even if you don't do that, I think if it's downloadable, then people should be able to do that kind of simply in Excel or something like that.
Stephen, you have to deal with grundles of data.
Yeah, no, a lot of times
What would work well for you?
Yeah, a lot of times, when I go to find out any information for a company, I go to their investor relations website, right? Their information could be gathered from there as a resource. We talked a little bit about maybe there's also qualitative commentaries, like in part of the MD&A, talking about changing auditors if it's done with within the parameters of national office. That's another potential, but those are areas where we typically gather. When I look at dig information I always go straight to the website for the investor relations for any information.
Okay. One last question that I'd received was, this data will always be historical in nature. You do the filings in February or March each year for a public company, and the audit reports are filed at that point in time. Any thoughts on getting the data out on a timely basis to investors? What would be a reasonable expectation with respect to how quickly the PCAOB requires this information on a specific engagement? Should it be like 90 days after the audit is complete? On a firm-wide level, should it be once a year? Any thoughts on that from the three of you?
If you look at the normal cycle, it might surprise a lot of people to know, but as soon as you finish an audit, the next thing you do is work on the engagement letter and fees for the next audit. And part of what's driving that is the need to retain an auditor, so then the auditor selection can be built into the proxy. So ideally, it would be nice to have that information right away so that informed decisions can be made about auditor retention and auditor ratification. I would like to believe that a lot of these metrics can be reported rapidly. There may be some fuss about that, but for the information to be useful, it needs to be pretty timely. And if you can go through the exercise of producing a 10K that's signed off as part of an audit, I don't think it's that much more to ask about at least some of these human capital related metrics be published timely.
Okay.
I
Reedy,
mean, I
Steve.
can't speak to how quickly that can be done, but I certainly, if you take the investor standpoint, it seems like if you can tell me the CAMs and you can sign off on the audit opinion, I'd like to see it at the same time. And I don't see why it shouldn't be. And specifically about the CAMs, I would hope that then firms might rethink how they do the CAMs in light of the metrics, because maybe the CAMs would give an opportunity to explain, the more complex areas of the audit. So Lynn, you were talking about you'd like to see the best people staffed on the hardest or most complicated audit. And I would like to see some sort of match between how complex, these critical audit matters are, and then does that map into the engagement metrics? And so it would be nice to have those kind of side by side, personally.
Okay. Well, we've only got 10 minutes left here, so let me throw a couple questions out. Hey, David, I see your question. You got a question, go away.
Just Lynn, just a comment on just the last bit of the discussion. In the UK, we have audit quality reviews, and they are influential. And there's some very good things about them. There's there's some issues about them as well. But they really focused the mind of the audit firms if they were getting low marks. But it wasn't because the investors were going to vote against them on the reappointment of the auditor. It was because when they went for the next bid, the audit committee said, but you've got a lower AQR score than the other person. And so I think that was why it was focusing them. So it actually played to that commercial nexus that everyone was talking about, Lynn, which is that the audited entity is the one that is appointing the auditor, and which is where a lot of the issues arise from. But actually, I think the AQRs were hitting that point and were influential as a result. I don't think that they're the answer to every problem, but I think they play a part.
Okay. Who is next? Hal? You were pretty quick to the trigger.
Thanks, Len. I did have one question in this education. These audit quality metrics that we're talking about, are they risk adjusted? We've talked about different audits having different levels of risk. Are they risk adjusted? And I'm going back to Bob's earlier comments that talked about we could aggregate audit quality indicators by office, but then that would favor some offices over others based on the level of risk for the audits that particular office was conducting. So I'm just curious as to the degree of difficulty adjustment, if any.
Yeah, I think that's a good question. Tricky to incorporate, but I think this gets back to the notion that when the metrics are published, I think the firm, just like issuers do in MD&A, they should, provide some color around the numbers. And an important part of that context would be, the risk of the engagement. So I do think it's a good point.
Yeah, Bob, I know that I played around with this in some internal data when I was at my old firm, and it was really interesting to see the performance of various engagements versus some risk metrics that we had developed internally. And it was very insightful, and we ended up dropping some clients as a result of it. But I was curious as to whether or not we had factored that in, but thank you.
Yeah.
Thank you.
Well, we do.
I see Jennifer is next, and then Nemeth.
Can I ask my question? Because
sure.
I've had my hand up since the middle of the conversation, and it goes sort of hand in hand with what Hal had said, and it's really directed to something that Stephen said quite a while ago. There's a lot of objection to providing engagement level metrics because the systems are different between the firms, and the network firms collect different data and they don't necessarily talk to each other. And, it's impossible to compare one engagement to the other, which gets to Hal's point, right? And what I've said when people have told me that is that, investors are used to adjusting. I mean, we're experts at non-GAAP measures and KPIs and key performance indicators now. I guess I wanted, Stephen made a comment with respect to other metrics, so the like, or by industry. I forget exactly what he said at the time. I guess my question to you, Stephen, is, do you believe that investors can over time adjust for what's necessary to understand these, and that we shouldn't seek perfection in the pursuit of pretty good something?
Yeah, I think investors will be able to adjust, certainly, and that's why it's important for me to have some sort of consistent information or metrics, so we are familiar with it. And I agree with you. It's nothing is going to be perfect in this world, right? There's a lot of immaterial information as well. So, but to your first part of your questions, I do think investors will be able to understand more and adjust to that.
I like to use the analogy of EBITDA, right? Everybody defines it differently, but investors seem to be able to navigate their way through it with some explanation. I think the same is true here. So anyway, I was just curious to see your reaction about whether investors could interpret that. Thank you.
Yeah.
Who's next? Saba? Who's next?
So next is Jennifer, then Nemeth. I also saw Alicia's hand.
Okay, thank you. Yes, thank you. So Bob, thank you for the comments you made about focusing on the members of the audit team and the issue with the staffing of auditors to address the concerns of audit quality, because like you, I think audit quality is strongly connected to the accounting pipeline challenge. So thank you, and I look forward to your comments on that. A question that I have for Stephen is the role of investors in demanding higher audit quality and greater commitment from auditors to providing more quality and more informative audits. He probably could give clearer data than I can on what is the value of firms, specifically the total assets, total revenues for SEC filings are in the billions of dollars. Audit fees on average for SEC filings, registrants, is approximately $3 million or less. So clearly, auditor is a credence good because investors are demanding a credence good. If investors wanted more detailed audits and more information, why aren't we seeing action and activity from investors demanding more information on audit quality and higher quality audits? There are investor initiatives for a vast array of things like ESG and different things like that. But I have not seen to date, I could be wrong, but I have not seen investor initiative and action on the matter of audit quality disclosures.
Yeah, certainly. One of the things I do think the auditors are akin to sort of leases, right? So if nothing, you're not seeing bankruptcies or et cetera, you're probably not going to, everything is fine. But as the recent banking crisis have, come into fruition, then people are starting to demand, hey, why aren't these information provided? And it's not. So my point is that there will be as the economy starts to get weakened, there's some questionable auditing practices, and you may see more activism in that area. So that might, hopefully that answers your question. But it's very difficult. You know, investors typically focus on one area. Right now, you know, all of last week was focused on interest rates, right? And they kind of move from certain sectors and attention from one area to another. You know, I remember this time last year, everyone's focused on the Ukraine war. Then there's ESGs, you know, now it's on this interest rate and what sort of concerns about banks. So, but investors are just, I guess, a nervous Nelly group, and typically, and you know, we always rely on these financial statements as consistent and like to have an unbiased view of these financial statements.
So to continue, you know, you say that you rely on the financial statements, and investors demanded CAM disclosures. CAM disclosures have been boilerplate, and yet we haven't seen investor activism pushing back on this. So I just, you know, I know you can't speak for all investors,
right?
But one of the issues I think that is being left out of the conversation is this, you know, that the investors have the strongest bully pulpit, you know, in terms of demanding, right? The PCAOB can act in terms of supplying and enforcing the supply, but the people who are in the power seat for the demand really are you, the shareholders.
Jennifer, let me react to that in a couple ways. First of all, investors like Steve and Amy and Mary here are extremely busy people. They've got portfolios of companies to track. There's phenomenal information on those companies that they have to track throughout the year as they all report and reach out to management. And also an area like the audit where the financial statements are, quite frankly, assumed to be correct because the auditor is putting that report on top of them. And they've got a regulator as well, actually, too, the SEC and the PCAOB in this case. There's somewhat a notion of prioritizing what you got to really spend most of your time on. And in this area, it's never been that the investors have gone out there wholeheartedly and delved into it because the data isn't available. And that's what the ACAP came to the conclusion of. Until you get the data out there, you're never going to have this switch from competition on cost to competition on quality because there's no information about quality out there. And even in the biggest funds, like Amy, the security laws are set up to that under the notion that they are all big and almighty and they can get whatever information they want out of in other private equity funds or whatever. That just isn't the truth. The people who have the data control the data. And a lot of times you basically have to set off hand grenades and dynamite to get those data out of those places. And so, you know, as busy as these people are, the reality is don't expect that to happen and happen all the time. It just isn't going to.
Can I add something to that, Lynn? Just based on the UK experience and in Europe, post Carillion and post Wirecard. If you look at the process that I've devoted substantial time to in the UK to absolutely no avail. I mean, we've been hearing that ARG is going to happen for 3-4 years, right? And it gets stuck in the political process. We have written letters to Bays, and Jeff joined me in asking for internal audits over internal control. We've done all these consultations. They've had fraud. It goes through this long duration of a political process that wears investors down until the next crisis, right? And so it's just that it takes too long, and sometimes that's not a bug, that's a feature of the process. And investors move on to other things. So, and you know, I've had people say to investors or directors and audit committee chairs in the UK say, well, investors don't ask me any questions about the audit. And I say, but you don't give them anything to ask about, to Lynn's point, right? So it's like you need to give them something to ask about, and you need to be willing to answer the question. So anyway, I just had to add to that. Sorry.
No, thank you, Sandy. This is a great discussion. I just want to make sure that we have, we give everyone the opportunity to ask questions.
Yeah, we'll get back to Nemeth here real quick, Brett. If Jennifer, if you go back and look at the transcripts of the public hearings on the ACAP, you will see that there was a consistent message from institutional investors that they did want this quality information. And that's why it's in that report. ACAP recommendations were issued 15 years ago, which goes to Sandy's point of this takes all too long to get this in place, and investors just can't be spending all their time on this. In fact, they're so busy, they've got little time to spend on this, especially when there's no data provided to them. Nemeth.
Yeah, just one quick thing to add with respect to what Jennifer said. Part of it is also that investors, especially the extremely large ones, are highly diversified. You know, so the risk of fraud for any one company in their portfolio or a few companies in their portfolio is just not large enough for them to use their capital to actually request information about audits. But coming to the panel, I thought it was a great discussion, and I found myself agreeing many times with a lot of the comments that came out. One thing is given that there are only 4 audit firms that audit the majority of the market cap of US companies, I question the value of having indicators, human capital indicators, incentive indicators at the firm level. If the audit quality indicators were even provided at the audit office level, I think it would have more bite and it could be more useful than the information at the firm level. And if the panel can weigh in on that, I think that'll be helpful.
I think, Nemeth, we all agree with you that engagement level metrics are certainly important, but those would be different metrics. They would be, more the human capital type metrics and things like that. But, I think, Daniel's work does an excellent job of making the case of looking firm-wide is still also valuable. And that's part of what the PCAOB does with our Part 2 findings, and I think that is very valuable. So I don't think it should be one or the other. I think it should be both.
No, the engagement level, I agree, is different. But if we cannot get information if there's pushback, if there's certain information that's not available at the engagement level, at the audit office level is another level of granularity that I think where the information would be more useful. And I'm very familiar with Daniel's work, as you know, right? With some of the descriptive evidence, there is a problem of causality, right? So it's hard to know exactly what's causing what. But this is why, to the extent we're fighting this battle, I think providing information at something that's slightly more granular than the audit firm level, I think would be a big win.
You might recall that Elizabeth Mooney from Capital had the same comment about getting data at the office level. I would ask you if, when you get a chance, take a look at those quality and transparency reports I sent you. In one of those, there was some, what I thought some good data on human capital and training at a firm-wide level. I'd be very interested in knowing your thoughts on if you see in any of those reports data that you think would be useful. I'd love to hear from you on that once you had a chance to look at them.
Can I add just one more point to this? To the extent some of this information is already public in terms of LinkedIn profiles. So in academic studies, people have used LinkedIn profiles to actually reconstruct what the audit teams look like for different firms, or even for different audit offices. And if that can be done in a more structured way, using even publicly available data, and made available to a broad group of investors, I think that also is an avenue to consider.
Okay. Sandy, Rich?
Thanks, Lynn. So just to follow up on Nemit's conversation, the investment world is not monolithic. 50% is passively invested. The remainder of the 50% largely is wildly diversified. I mean, we are protected far more in our asset allocation than we are from auditors, to be brutally honest. SVB is a perfect example. We lost $600,000. We have 5,000 individual equity positions. We would pay $105 per company to protect us from that loss, and no one's going to give us that underwriting liability. No one will do that. So I think, you have to be careful about making broad statements about the investment population use of these tools. The vast population of investors has no use for them, to be brutal. And I would raise the question on AQIs. I think they're very valuable. I'm an audit committee chair. I've been an audit committee chair of multiple public companies. I use them, but we are a delegated society, right? Investors delegate through their proxy to the directors and audit committee. Audit committee makes the decisions, and company deals with the feedback, and we have the PCAOB to watch our auditors for us. Not that AQIs are bad. They're good. They're good. We use them. I think it's a lot to ask an investor to review 28 new data points and expect them to integrate it into a fundamental decision, which is overwhelmingly driven by the strategy of the company they're examining. And I was also a PM for 20 years. So, I mean, I did this. I was with Steven. I was a junk bond guy. So I think it's, yeah, okay, that's enough.
Okay.
May
Well,
I,
I think
Lynn, may I add to that, please? Because, I think the data matters. And I think what the PCAOB is beginning to provide broadly to the public, ideally in a searchable database format, will be very, very valuable. But if I think about the ability to influence, the data from the PCAOB is pretty much telling us that all of the top 4 audit firms, plus at least 2 or 3 of the next level down, they've all got issues. So if I put my audit committee hat on, I'm looking at this and I'm thinking, well, there's no differentiation. From a commercial perspective, am I not better served to drive the fee down and use the differential in the fee for next year to add to my insurance coverage? I think that's a very realistic consideration here, right? So while the tracking is important, absolutely it is in order to be measured, the outcomes, the impact and the outcomes vis-a-vis the audit firms is just as important. And there's a large adjustment process that likely is going to take a little bit of time to come through, as was alluded to, or actually explicitly stated in one of the previous presentations we just heard today. So
it's interesting.
Each of these are important components, but they can't be viewed as silos. They're not silos. They've got to interact with each other in order for it to be useful. And to think that an investor, whether you're running a 5 billion fund or a 100 million fund, you get to the CEO to talk to them. I've never, as an investor, had an opportunity to talk to someone on the audit committee, let alone the audit committee chair, to be able to ask some of these questions, right? The expectation is that the audit committee is doing their job, and the board as a whole is doing their job. The financial statements and the discussion around the financial statements typically stops at the CEO and the CFO level.
You say that, Alicia, but I've got a white paper out there, and in fact got a call from a U.S. senator in the last couple of weeks on it, where I propose that we modify the security laws and drop the requirement for an audit, so it's not government mandated, and instead The investors would vote once every 3 to 5 years. And if they approve having an audit, they'd have an audit. If they don't want an audit, they don't have to have an audit, but instead of the government making that decision, it would be the investors. And therefore, you get a direct link between the investors working for, or the auditors working for the investors rather than for management. But when you talk to investors about dropping the requirement for an audit, they go crazy. So this audit is, oh, not so important until all of a sudden, if you don't have it, God has just struck lightning. And then all of a sudden you got their attention like never before. So their behavior doesn't always reflect thoughtful, reasoned approach to things. Again, they're thinking about their rate of return. And to Sandy's point, especially if you got an index type fund, you know, the audit just isn't as important to an index fund as some of the other things, and that's what they focus on. That doesn't mean it's actually not as important. In fact, it's darn important. And when you start telling them they may not have one unless they vote for it, they've got a different view.
And it's Amy. I'm sorry. I think we got to move on, but this has been a really fun, enlightening presentation and panel. So thank you, Lynn, Bob, Preeti, and Steve. It's really, really helpful, and I'm sure it provided plenty of information and ideas for the board to consider. So next on our agenda is the IAG's recommendation to improve critical audit matters disclosures. The recommendations follow the IAG discussion on this topic during the June 7th meeting. The purpose of the session was to explore investors' perspectives on the effectiveness of CAMS since its implementation in 2019. Sandy Peters, who is a valued member of the IAG, will provide the recommendations. Sandy, I will give the floor over to you.
Great. So when I was asking questions, I was just stealing time from myself. That's good. I talk fast. So as Amy said, the June meeting is what led to our sort of listening to these items, considering some other items, and pulling together what we think are recommendations for the PCAOB as it relates to critical audit matters. I think that the general concern is that it's unclear how we end up with, I think it was 1.2, and they are very much boilerplate, and they describe more of the audit procedures than the findings. So I thought I've sent around a draft recommendation document that to the various members of the IAG, and I will brush that up. But for purposes of our conversation here, I've just put some bullet points together on a slide if somebody wants to move, and I'll just run through these quickly. So the first recommendation is that the PCAOB revise the March 2019 staff guidance on the determination of CAMS. And if you look at that staff guidance, it was issued prior to the release of any CAMS. But within the staff guidance, it says that critical audit matters, you know, how they're assessed, but it also includes a statement that matters are assessed on a relative basis within the specific audit. And we believe the staff guidance needs to be removed, updated, not only because it was done prior to the issuance of any CAMS, but because the standard does not actually say that critical audit matters are to be assessed on a relative basis within the specific audit. They are to be assessed against particular factors that are articulated in paragraphs 11 and 12 of the standard. And we believe that those are to be assessed on a particular matter. So we believe that needs to be modified. And within the written documentation, there is a specific, a much more detailed explanation of that item. The second item is that we believe, the second recommendation, I should say, is that the PCAOB should focus on CAMs as a part of inspections, which I know that they already do, but we have a broader sort of cross-cutting recommendation here. So, and we believe that the PCAOB inspection enforcement staff should execute a large-scale examination of audit work papers and see how CAM determinations are being made and documented relative to the standard broadly, and more specifically as to whether CAM determinations are being made on a relative rather than absolute basis upon a separate assessment of each matter against the factors in the standard. And we believe that the inspections team already has a significant amount of information on those. So it could be done now based on that information, or if additional cross-cutting inspection or additional review and review across engagements that companies needs to be done could be added to. And we would recommend that the PCAOB issue a report sharing the results of its review in an inspections-related board report or statement, which is a process that the PCAOB has followed in other new standards. I believe one on audit committee communications. So that's the second recommendation. There was also concern expressed during the panel with respect to the use of the term especially challenging, and I don't have the exact word here, especially challenging and subjective estimates, whatever. I don't remember it off the top of my head, sorry. We believe the PCAOB should revise the especially challenging used in the standard to something either as more challenging or just simply challenging, because we believe the notion of especially challenging is reducing the number of CAMs to possibly just the one that we're seeing, when in fact it is not. We want disclosure of the things that were challenging for the auditor to do, to make an assessment or conclusion on. Sorry, I'm trying to do this quickly. The next item is that we believe that Jeff Mahoney on the Investor Advisory Group noted in the June meeting that paragraph 14 of the standard, specifically paragraph 14C of AS 3101, in a note, though the standard requires description of how the critical audit matter was addressed in the audit, there's a note that follows that statement that says the auditor may describe what they did, what their observations were, and no one is doing, I think there's 4 items that are listed, and 3 and 4 are not being followed, or sorry, not being done. They're not required because there's a may. But in virtually all of the critical audit matters, there's a report on what was done, but nothing with respect to what was found. And investors in their original asking for or request for critical audit matters had asked to know what auditors found. So that was another recommendation that the committee made, and one thing that was discussed during the meeting back in June. The next 2 items is outreach to investors and research on matters of importance to investors. And I note that in the 2 subsequent reviews of the standard done in 2020, I think it was the fall of 2020 and then the fall of 2022. And I believe the one in 2022 we discussed at an earlier meeting of the Investor Advisory Group. There was a survey done of investors. I think 50 people responded. Only 50% of the people said they had looked at the CAMs, and only I think 60% found them useful. So basically, we have something like 15% of the people or 30% of the people actually finding them useful. But the survey asked very broad, general questions with respect to the CAMs. And I know that the academics here and Jeff and I have looked at some of the CAMs, and we believe that it would be good for the PCAOB to do more detailed outreach to investors, taking a particular CAM or a series of CAM and walking investors through the CAMs and saying, do you see the amount in question? Can you tell where it's located in the financial statements? Where is it described in the notes? What the specific element that made it, can you see the specific element that made it challenging? And really have a more detailed conversation with investors with respect to what they think and see about these, with the hopes of possibly in improving them. I know if you look at the 2020 survey of investors, it says those that have actually looked at them, the single one that is most commonly referred to, I think 70% said that they looked and they identified one related to revenue. My experience in looking at CAMs when there is a CAM on revenue is that it's very difficult to determine the amount that's being the subject of the revenue discussion, the amount in question. It will simply refer to the financial statement caption, and there generally is not great disaggregation on revenue, and generally there's no or very little footnote disclosure on revenue. And the CAM will actually just reference the critical accounting policy. So you're sort of left with not a lot of information with respect to sort of the issue at hand. And so we think a more detailed outreach, looking at case studies of the CAMs and what could be done to improve them, would be useful. And hand in hand with that, we think it would be good for the PCAOB, either itself or working with academics, to do greater research on the matters that they believe that are important to the company and the matters that they believe would or should be, from their perspective, to be especially challenging to audit, likely because they have a high degree of subjectivity or estimation, or can be manipulated. And investors do have those perspectives, and see and discuss with the investors why that was or wasn't included in the CAM and what could be done to make it a bit more useful. So basically those collectively are really just a more detailed conversation with investors with respect to the CAMs that are included. The last item was one that several members mentioned, was that the IAG should annually solicit nominees for what people think are the best CAMs, and the IAG to evaluate them and discuss what are the particular features of those CAMs that make them noteworthy. And Jeff can give you a better description of what he thinks would be useful there. But it's really about having the investor advisory group look at CAMs and highlight what they thought are useful features of CAMs, with the hope of making them more useful. So those are the, I guess, 6 or 7 recommendations. There was a discussion with respect to the difference between KCAMs and CCAMs, and the need to have more similarity with them. But I believe that more research needs to be done and greater discussion amongst the IAG. So we haven't included that item yet in the recommendation. So with that, I'll pause. And sorry, I've tried to go to that quickly, and ask for anyone's comments or questions on the topic. Jeff, you have your hand up.
Thanks for that, Sandy. It was very helpful. At the beginning of this meeting, I asked Barb a question about whether the PCAOB could pursue a narrowly scoped project. And Barb's answer was yes. So I would respectfully suggest the following narrowly scoped project that I think would address the two issues that many have raised about how 3101 is not being implemented consistent with the intent. And both these issues were touched upon by Marty at the last IHE meeting, who formerly held Barb's position and was around when 3101 was finalized. And they relate to the third and fourth bullet point. The word especially is Sandy's third bullet point. The fourth item is what I've commented on and which she repeated, which Marty agrees with, the note to paragraph 14C, that there's two items, 3 and 4 in that note that many stakeholders asked for during the development of CAMs, but they're not required. And to my knowledge, not a single CAM disclosure yet has responded to either those 3 or 4. So I would respectfully request we consider a narrowly scoped project that could change as little as 10 words in the standard to fix the two main problems with 3101 and how it's been implemented. One, the number of CAMs, as Marty pointed out, is fewer in number than what they intended, and that can be fixed with the word especially. And two, the content of the CAMs do not include the type of information that many stakeholders, including investors, desired during the development of the standard. And I'm not aware of a single CAM where those items 3 and 4, the note to 14C, have been disclosed. So I, again, respectfully request we consider a narrowly scoped project to just change a few words and address those two problems with the implementation of 3101. Thank you.
Thank you, Jeff. I see Lynn's hand up. Then you're next.
Echo Jeff's thoughts, but I think within those 10 words may lie the reason we get more K-CAMs with more information in them than the C-CAMs here in the US. And I think if the board would look at that, do a narrowly scoped, it could also find the right 10 words that would respond to David Wilson's comments regarding the climate change K-CAMs. I don't agree with David that it's quite as simple as what he says, but I think in a narrowly scoped project, you could resolve that by looking at the differences between the standards here and internationally and figure out the right 10 words to get us the much better K-CAMs.
Yeah, no, I'd follow up on what Lynn said. I mean, we have this, well, I mean, I think it sort of starts with Marty Bowman saying the CAMs are not doing what they were intended to do. And then on top of that, you have this, a rather stark example that for dual listed companies, there are CAM key audit matters which are covered internationally. They're actually removed when the filing is made in the States. And that might be because the wording is wrong or the wording is different. And I think if it is, it would be good for the PCAOB to understand why that's happened and whether that was what the intent of the CCAM was, or whether the wording needs to be changed, as Jeff and Lynn are saying. I mean, it may be possible that this is just a misunderstanding and that you don't need to change the wording. That would be wonderful if it was true. But we should at least understand, why is this happening? And if it is happening, was that the intent of the CCAM or is this a pretty clear example of what Marty Bowman was telling us? But just a very simple project like that, I think, would be very valuable. It would just clarify things.
Sorry, just to follow up David and Lynn's point, I had conversations with the IAASB as to what they saw as the distinctions. And one of those distinctions was the word especially, which they felt led to US auditors providing fewer cams. So David, if we just make that fix that Marty Baumann suggested, we would get more cams. So we potentially would get more cams that would be responsive to your request.
Yeah, I think that's right, Jeff. And actually doing this wouldn't be too difficult, because I believe that the auditors need to have need to document the issues that have been raised with the audit committee and whether or not they've been taken forward as KCAMs or CCAMs. So we have ones that have been taken forward as KCAMs but haven't been taken forward as CCAMs. So we can see very clearly, just by going back to those papers, what was the logic that stopped this? Is that what we intended? Maybe it was, or maybe Marty Bowman's right. But if it wasn't what we intended, we can change the wording that's creating the blockage, and we can resolve this. But I would have thought we were resolving this for CAMs overall, CCAMs overall, rather than just this narrow issue. But this narrow issue is just a wonderful example that would give us the data to be able to discover where the blockage is.
Yeah, thank you. I would also like to follow up and endorse the proposal, and particularly the suggestion in getting to increase the number of CAMs that are being disclosed in the audit opinion, because research has really shown that when something is highlighted in the CAM, it actually prompts greater voluntary disclosures for management about the risks that investors are trying to get more information on. So if we could get at least greater number, we won't have to rely on the auditors, but the auditors just highlighting the fact will prompt the managers to disclose the information to the investors.
I would just reiterate with what Jennifer said. I had a conversation with someone yesterday, and that from a firm, and we went back and forth, and there's no desire to create original disclosures by the auditor that the management didn't already make. So the effect is to improve the disclosures that the company actually actually makes, right? And yeah, I'll leave it there.
One for dialing in this afternoon. This was a great discussion. We have already sent out the date for the next IAG meeting. We'll share an agenda as we get closer to the meeting. Amy, do you have any closing remarks?
Saba, this has been really great meeting, so thank you.
Thank you. The meeting is adjourned.